Bank of India has unveiled its next round and fresh round of instruments to tackle the economic issues that we are facing in the wake of the COVID-19. In his third major announcement since the lockdown began, Governor Shaktikanta Das today reduced the repo rate by another 40 basis points, extended the moratorium on term loans by another 3 months, so that's a total of 6 months, and also said that the economy for this year is likely to grow at a negative rate. That means growth is likely to shrink. Those were the major headlines that came out of the announcements today. Before we move ahead, let's take a quick look.
In his third press conference since the lockdown, the RBI Governor Shaktikanta Das has bolstered efforts to fight the economic mayhem caused by COVID-19 by cutting interest rates further and extending liquidity to all. Amidst all the gloom and doom predictions, the RBI Governor has chosen to start on a rather philosophical note.
It is when the horizon is the darkest and human reason is beaten down to the ground that faith shines brightest and comes to our rescue.
The Governor has tried to come to the rescue of the Indian economy with a 40 basis point cut in repo rates, an extension of moratorium on all term loans by another 3 months, extended group limit exposure for corporates, and allowing businesses to pay interest on borrowings of working capital by March next year. But despite all these measures, the RBI Governor minces no words on the dark clouds gathering over the economic horizon.
GDP growth in 2021 is estimated to remain in the negative territory, with some pickup in growth impulses in H2 2021 onwards.
While the RBI has made money cheaper for borrowers, it will also impact savers negatively. The chairman of India's largest bank, SBI, has confirmed that savings rates are headed south.
What is the kind of impact you see on savings rate? We've already seen some cut in retail rates. Do you see that extending?
The interest rate scenario as of now is that interest rates are going down. So when they go down for borrowers, they go down for depositors.
Central banks around the world have stepped up to ease pressure caused by the global pandemic. The RBI has already acted thrice, but now the question is whether all of it is going to be enough in an environment where demand continues to remain depressed.
Now the question is that despite all of these measures, why is there still a sense of whether this will be enough? It was reflected in the markets today with the way banking stocks reacted. Economists as well have been questioning whether this will be enough, and what does it really mean for those who are borrowers and those who are lenders. To speak on this, I am joined today by Mr. Mallikarjuna Rao, who's the MD and CEO of Punjab National Bank. Mr. Ashutosh Khajuria is joining us today, the Executive Director and CFO of Federal Bank, and Dr. Ghosh, Group Chief Economic Advisor of SBI, also joins us on the show. Welcome to all of you and thank you for speaking with us today. Mr. Rao, let me get straight to it. The concerns that the markets had today and those who are watchers of the economy have is simply this: the moratorium has been extended and all the dues, the interest which is due, can also be turned into another term loan. Is this going to have more pressure on banks' balance sheets?
No, we'll have to divide into two parts. First is the kind of a situation where we are passing through is never experienced before globally. As such, the kind of measures which are taken by RBI or Government of India are on the assessment based on the date when they are declaring. As such, if the market expectation is high, then what is declared, probably that is reflected in the the share price or otherwise. However, the reality is, unless we are very clear on the assessment of how it is going to impact, code is going to impact, it would be very difficult at any point of time to declare the measures required. If you look at as on today, what RBI has done is definitely a good thing in terms of covering various areas. Coming to the impact on banks or a fear of NPA, first thing is that moratorium was required to be extended. It has been extended by 3 months. FITL has been introduced only to take care of the easiness of handling working capital facilities, because in working capital facility, after 6 months of the moratorium completion, the entire interest is required to be paid by them in order to see that the account is operated well. That has been taken care by RBI by indicating that in all those working capital accounts, the interest accumulation during the 6 months of moratorium will be converted into a funded interest term loan, and that has to be paid before 31st of March. Besides, the moratorium will be definitely playing out well for the borrowers who have not come to normalcy as on today. We expect that the things will improve in the days to come. However, the position will be known. We can assess as to the impact of NPAs in Q3 or Q4, how many of these accounts where moratorium is permitted would be able to come back to normalcy, how many will struggle to come back to normalcy, how they are going to impact the bank balance sheet, can be assessed little more pragmatically either in Q3 or Q4.
You know, Mr. Khajuria, the sort of commentary all of this time has simply been that there is no real liquidity issue. There is enough liquidity in the system. We have seen a sort of tepid response to the first 2 rounds of cuts by the RBI as well. And the question has always been whether there has been a transmission by the banks. Today, the governor said, yes, banks have improved their transmission, but the risk aversion still remains, isn't it? Do you think there is going to be enough of a demand for credit, and is that risk aversion a real concern for banks as well?
You will have to understand the balance sheet of Indian banks. Being almost 90% of the balance sheet on the liability side is from public deposits. Now, these public deposits within that, even if you take about 35 to 40% of CASA, the remaining part is term deposits, and these are also called fixed deposits. That means you are committed to pay a fixed rate of interest to your depositors. So basically, the entire loan and advances portfolio is being funded by the public deposits. If you see for any bank, even if it's capitalized, if CRAR is something like 14-15% of the risk-weighted assets, if you just see the net worth part, if you just see the capital and reserves part, it would be hardly 10% of the total liabilities. Very little borrowing, because Indian banks are not that much dependent on market borrowing to fund their assets. They are dependent on public deposits. Now, if you have that structural problem where you have very, very small amount of floating rate, liabilities, because savings bank also is more or less a off late unit has become a floating rate where some banks have linked their savings bank deposit rates to repo rate, and therefore it has become floating. Otherwise, it used to be a fixed rate on the liability side. I mean, there had been period as long as a decade where the savings bank rate of interest has not changed at all. So when you see the liability structure of Indian banks, the transmission was a problem. Monetary transmission happens where the dependence is more on market funds. Market funds could be your CDs, it could be interbank borrowings, it could be borrowings from Reserve Bank of India, and all those things which are linked to the market rates. Market rates change immediately when the repo rate is changed, policy rate is changed and all. Now, on the asset side, effective 1st of October 2019, your retail assets and your MSME loans, new ones have been linked to external benchmark. And most banks have linked it to a repo rate rather than treasury bill. Initially, some banks had linked their retail, home loans, etc. to treasury bill, but treasury bill was more erratic in the sense, the fall was steeper than the repo rate cut and all. So of late, majority of the banks are linking their assets to policy rate. Now, on liability side, if you have savings bank linked to repo rate, and on the asset side, if you have the retail loans and newly acquired MSME loans, etc., linked to repo rate, it balances your ALM and all. So I think the question is not that banks are averse to risk and all that. First is they have to take care of their ALM requirement. Secondly, they have to see what is the structure of their liabilities, and accordingly, I cannot pay a lower rate of interest to my depositor where I'm committed at a fixed rate of interest. So if a maturity value for a particular deposit is say 100,000 rupees, it has to be 100,000 rupees on maturity. I can't say that repo rate has been cut by so many basis points and therefore I'm paying lesser to my fixed depositor. that is not possible. So I think that was the main reason, rigidity in transmission of monetary signals with immediate effect. It used to happen, but it used to happen with a huge lag. Now, why it has improved? You made a statement that even governor said that there is a better transmission now. Why? Because you have on both sides now linking to repo rate and all. And now on risk aversion, I would say there has to be demand of credit. If there is a demand of credit, banks are ready to lend. I'll stop there. Thank you.
No, absolutely. The demand of credit is a very important point. And, I just wanted to add for our viewers that it was made very clear today when we had a chance of speaking. I had a chance of speaking with the State Bank of India chairman as well, that savings rate will drop. Before I move ahead, I want a quick round of responses on this from both the bankers. Mr. Khajuria, you want to go first. Savings rate, you see another significant drop after the announcements today, and that's important for all kinds of viewers right now. Those who have their money in FDs or in savings account, and they need to know that there's going to be a loss of income from savings rates.
No, I think whenever we talk of policy rates and monetary transmission, probably we just focus on how the assets are priced and how much pass-through is happening, whether it is in a falling rate of interest or when they are rising rate of interest, how much banks have raised and all that. Focus is always on the asset side. But my point is, I think it should be more on the savers side. Savers need to be encouraged. They need to be, given the reasonable return on their deposits and all. Unless you have savers there as an intermediary, where would we have the funds to provide it to the users? So I think they are to be taken care of, and banks are very cautious when they look at, cutting the deposit rates and all. I don't say that simply because 40 basis points has been cut on the policy signaling rate, we'll straight away be cutting, 40 basis points on savings bank or proportionate, 40 basis points on fixed deposit rates. Not necessarily, because bank deposits compete with other, saving instruments, other financial saving instruments. We have to look at what are the NSSO instruments and all. Your Kisan Vikas, your NSCs, your PPF, and various other, instruments, which are there in the market. And apart from that, we also have to see what type of returns mutual funds, liquid funds are offering and all that. Within those constraints, because we are competing, you're just talking of banking industry, we just don't go by straight away. Whatever is the policy signaling rate, equal amount would be cut on deposit side and the advances side. Doesn't happen like that. Elcos would be sitting, their meetings would be happening. There would be, analysis of the data, and we would look at, how much we can pass through and how much to that extent we have to cut on the deposit side. Please remember, the existing deposits other than savings bank and current account, deposits.
No, fair enough, Mr. Khajuria. Yes, fair enough. But, since this announcement this morning, a leading private bank has cut its base rate by 55 bips. Mr. Rao, I know you will also say, of course, the ALCO will decide and that decision will be taken. But I'm asking directionally. Rates are going down, and this will be across all sections, including for depositors and savers.
Very true. See, as an emerging economy, we cannot ignore the requirement of savings generation in the country, which indicates very clearly that there is also a limit for the downward movement of the savings interest rates, whether it is a term deposit or even savings. So I am of the opinion that if we are breaching below 2.5, it will not be in the interest of the economy. Already in State Bank of India, the savings rate currently before this repo reduction is 2.75. In many of the banks, it is hovering around 3.25. Coming to Punjab National Bank, we have two buckets. One is 3, another is 3.5. Little higher because we wanted to maintain the same in view of the amalgamation where we are getting a franchise from East, which was carrying a higher interest rate. We did not want to send a negative signal. But however, this aspect will be discussed during the ALCO. Coming back to generality on savings, I still feel very firmly that breaching below 2.5 may not be in the interest of the economy always. Now, coming back to repo cut, remember that these two are extraordinary situations when RBI had reduced with 75 basis points and 40 basis points. 115 basis points have been reduced, under extraordinary circumstances. So the initiative taken by RBI under extraordinary circumstances should not be construed to be applicable for the general economy as such. So we expect that after the COVID impact is reduced, some element of moderation should come. So while interest rate reduction is always good for economy, there should be a limit for it, because interest rate reduction alone will not be creating impetus for the economy. There are various other factors which also need to be considered for looking at it. One more point, like Mr. Khajuria said, in our country still, in the banks, majority of the component for lending comes from the deposits. The market has not matured to get sources from outside, while TLTRO was one of the options created by RBI, where long-term repo operations are available for 3 years, which can be effectively used not only for investment but also for the lending by the banks. It is still, the maturity is yet to come. As such, I opine that there is a limit for downward trend even for the deposits. We need to look at other avenues for creating impetus to the economy, while at this point of time, the decision taken by RBI is in right direction.
That's actually a reassuring word coming from two top bankers on the show, that the downward trend of savings rates will be there, but there's a limit to it because it will harm the economy in the long run. Let me get the economist on the panel in and his view as well. Dr. Ghosh, welcome to the show. I want to get your take on what has been said, assumed, but today certified by the RBI governor, that India will have a negative growth this year. He's of course stopped short of quantifying it because frankly no one knows what's coming up ahead. But how bad do you see the signs?
Yeah, I think Tamanna, the situation this year, we need to understand that we are in unprecedented times this year. The first quarter has been, we have been in a lockdown mode in the first quarter, and the current trend suggests that June may not be that good. So possibly you will lose 3 months of GDP data. So out of 12 months, if you lose 3 months of GDP data, obviously there's going to be a contraction. So how deep is the contraction? That's going to the point. In our sense, the contraction is going to be deep and protracted. So that's point number one. The second point I would like to say is that the current crisis basically is going to be completely different from the earlier crisis, because in this crisis, you have an impact on social consumption. Basically, the service sector of India has a 60% share. And this sector actually will need support, government support, fiscal support, long after the pandemic has ended. So in that sense, I think what the RBI has done today has been fine. The central bank has been significantly proactive. It has been actually using, if I use the words of the famous the US Fed Governor Ben Bernanke, constant discretion. Basically, it's using discretion in monetary policy and not going like the pure textbook of rate cutting. So I think that's the most welcome part. But I also believe that the government has done a fiscal policy, but the direct impact of the fiscal policy is limited as per our estimates at 1% of GDP. So I think once the lockdown is lifted and once we understand the gravity of the situation, because right now it may not be possible to understand gravity because there is no such data which is coming out. So once the data starts coming out, for example, on May 30, last week of May, when the data for the last quarter come out, you can see actually a significant deceleration in the fourth quarter GDP number, which could slide to maybe around 1% or so. So once the data starts come out and you understand the gravity of the situation and you get out of the lockdown mode, we need to reassess and possibly maybe support the economy at a later point of time.
Yes. No, that's a good point. We're kind of in a pause mode, right? The lockdown is like a pause button on the economy and all economic activity. So it's difficult to assess what comes next. Before we wrap up, I must get a quick word from both the bankers on the extension of the moratorium. Mr. Khajuria, let me start with you. What is the kind of response that we have seen in phase 1 of the moratorium, and do you see a larger number of people and borrowers really opting for the moratorium extension of all kinds, and what is the impact of that?
So I think it varies from bank to bank. There had been some banks who announced their results in the early part of, or rather first half, middle of April or so. From there on, you started getting the results of the banks. And by that time, I think the number of people opting for moratorium probably would not have grown to that extent, because it was announced in the last week of March, I think, if I'm not mistaken, 27th March or so. So March was there in moratorium, April was there, and May was there. So as borrowers started reaching out to banks and all, there were, different sort of segment-wise options also given by various banks. Some said for smaller loans and all, it is opt-out, means everybody gets it. But if you want to pay, if you want to avail of any moratorium, you can continue to pay by opting out of that moratorium. So I think you have a range of about 8-9% of the by value of the loan book to something like 60-65 in case of Bandhan Bank. I think they said it's about 60-65% of the borrowers who have opted for moratorium. I think if you take the median for larger private sector banks, and results of public sector banks are yet to come, and then all, the number comes to be closer to about between 30 and 40%. So around 1/3 of the loan book would have been under moratorium if you just take the median as on date, because we are towards the end of May, and there is a fairly good now understanding of, or rather realization of, what type of moratorium, what type of borrowers have gone in for moratorium and all. There are some who have, even if offered, have opted out of it. They said because ultimately the interest burden would be on us, so we would pay. So that way, they have been paying and all that. Almost 2/3 of the book is not.
I have to get a point on that.
Yes, please.
Yes. In fact, the finance minister said about 3.2 crore accounts have opted for it. Mr. Rao, I have to get a word on that. Maybe more people will opt for it as the lockdown extends, maybe less will. But among, the average borrower, this grouse remained that the moratorium was given to us, but was it really of any great easing of our burden, considering we have to pay the interest eventually, it will compound, and a lot of banks made it sure to tell borrowers that this is bad for you, please don't take it.
No, I would like to say what finance minister stated is in terms of the number of accounts, even for PNB, if you look at in terms of number of accounts, not by the value, 90%, more than 90% moratorium has been given. We have given to everybody by default. We have informed the borrowers that it is in your interest, if you are having, if your cash flows are permitting, you please pay the money so that interest on interest can be avoided. However, by default, it is available to everybody, except where in case of NBFCs, we have handled that on case-to-case basis, because NBFC is completely a different segment, whereupon their access to funds from different banks are not uniform. It will be heterogenic in terms of the repayment. As such, case-to-case basis, it was required to be dealt. Accordingly, we have dealt. So moratorium is a good relief for the people, because there are problems in terms of the MSME, there are problems in terms of services industry. This will give a good advantage to them to come back. However, interest burden, yes, definitely will remain. As far as the term loans are concerned, the repayment, these installments and interest need to be paid at the end of the repayment schedule. As far as the cash credit is concerned, now only RBI today clarified for converting that into FITL. So from PNB perspective, we have given to every borrower by default except NBFCs. However, we have told them that whenever cash flow is permitting, kindly make the payment. Automatically, interest on interest will not be there.
And they can opt out. I will have to end here. Gentlemen. I've absolutely run out of time, but I want to thank all of you for joining us on the first big story.
Thank you very much.